This video is based on current market context showing the S&P 500 around $7,537 in early July 2026. Brent crude averaging about $80.47 in July after $85.40 in June, and a Federal Reserve that remains concerned about inflation while weighing whether higher rates may still be needed. Hello everyone. Today we are going to walk through a practical what-if analysis for the stock market between now and the end of 2026. The big question is this: how should investors think about the market if the Iran situation stays contained, gets worse, or fades into the background while rates and AI take over the narrative again? Right now, the market is balancing several forces at once. On one side, the S&P 500 has been trading around the mid-7,500s, which means valuations are already reflecting a lot of optimism. On another side, Brent oil has stayed elevated this summer because of tension around the Strait of Hormuz, even though prices have not gone into full panic mode. And on top of that, the Federal Reserve is still watching inflation closely, with officials signaling that rate hikes are not off the table if price pressures stay sticky. So instead of making one bold prediction, it is smarter to think in scenarios. That is the purpose of this framework. Let's start with the base case. In the base case, the Iran conflict stays in what can be called a skirmish regime. That means there are still occasional strikes, tanker threats, and pressure around Hormuz, but no full shutdown of the strait and no major U.S. ground invasion. In that kind of environment, Brent oil probably stays in a band of roughly $75 to $90. The Fed would likely remain cautious and mostly on hold, because oil pressure makes inflation harder to tame, even if the broader economy does not fall apart. In that situation, the S&P 500 could end the year somewhere around 7,000 to 7,500. That would mean the market basically digests its gains, deals with some valuation compression, and finishes with a more normal second half. Now let's look at the upside case. This would be the de-escalation and soft landing scenario. Here, back-channel diplomacy works, shipping through Hormuz normalizes, and the market decides the worst geopolitical fears are off the table. If that happens, Brent could slide back into a $65 to $80 range. Inflation pressure would ease, and markets could begin to believe the Fed is truly done hiking and may even be closer to cuts in 2027. In that environment, the bullish narrative would return. AI investment stays strong, earnings hold up, and the S&P 500 could press into roughly 7,600 to 8,000 by year-end. That is the optimistic path, and yes, 8,000 becomes possible in that scenario. Next is the downside case, and this is probably the one investors should respect the most. In this setup, you still do not get a ground war, but you do get a larger shock in Hormuz. Maybe there is a major tanker incident, a sustained shipping disruption, or a major strike on regional energy infrastructure. Then oil could jump into the $95 to $120 range, at least temporarily. That would put the Fed in a very uncomfortable position because growth would slow while inflation rises again. In that scenario, the S&P 500 could end the year in something like a 6,200 to 7,000 range, which sounds dramatic, but historically a 10 to 20% correction is not unusual when markets are richly valued and new macro shocks appear. There is also a fourth case that investors sometimes underestimate. That is the policy error and sticky inflation scenario. In this case, the geopolitical situation does not become catastrophic, but it also does not improve enough. Oil stays uncomfortably high, maybe around $85 to $105. Inflation refuses to cool enough, and the Fed either tightens again or stays hawkish much longer than investors want. In that world, the market may not crash, but multiples compress, and the S&P 500 could settle somewhere around 6,500 to 7,200 by year-end. So what is the main takeaway? the market is probably not just trading one issue. It is trading the interaction between geopolitics, oil, inflation, the Fed, and whether AI earnings can keep justifying premium valuations. If Iran pressure stays controlled, then rates and earnings matter more. If Hormuz becomes a true energy shock, then oil and inflation can quickly take control of the tape. For investors, that means the most sensible approach is not to bet everything on one headline. It means staying aware of the triggers that move us from one scenario to another. Watch shipping conditions in Hormuz. Watch Brent crude. Watch inflation data. Watch Fed language. And watch whether AI-related earnings continue to come through strongly enough to support the market's current valuation. If the base case holds, the market can still finish the year at respectable levels, even with more volatility. If the upside case develops, 8,000 becomes realistic. If the downside or sticky inflation cases take over, then a move towards 7,200 or even below 7,000 becomes much easier to imagine. That is the framework, not one forecast, but a range of outcomes tied to identifiable risks. And in this environment, that may be the most useful way to think about the market between now and year-end 2026. If you enjoy this video, remember to like, comment, subscribe, and turn on notifications so you do not miss out on my next videos.